Good morning, Chairman. You may begin.
Good morning, everyone. I would like to call this meeting of the FDIC Board of Directors to order. Before turning to the agenda, I do want to quickly congratulate Acting Comptroller Hood on his tenure at the OCC and thank him for his partnership on a number of issues that we've gotten to work together over the past few months.
Thank you. I've been honored to work alongside all of you, and I will be providing a statement for the record just to show my appreciation.
Let me just join Chairman Hill in saying I've enjoyed getting to know you, working with you, and looking forward to that continuing. But thanks for your service in this particular body, and look forward to the weeks ahead.
Thank you very much.
Something you want to read now?
Well, I'll just read an excerpt for it because I do want it to capture something that I think is really near and dear to my heart. And that is this, you all. Over the course of my nearly 30-year journey in financial services as a banker, a regulator, and a public servant, I have undeniably come to deeply value the role that the FDIC plays in safeguarding the financial security of the American people. Our two agencies, the OCC and the FDIC, share not only regulatory responsibility, but a rich history rooted in moments of national transformation. Together, we have helped strengthen public confidence in our financial institutions across many generations. And to my fellow board members, thank you for your collegiality, insight, and partnership. And to the FDIC staff, your dedication, professionalism, and quiet excellence are the engine behind our agency's success. You embody the very best of public service. And Deborah Decker, I certainly want to thank you for your leadership as board secretary. Thank you.
Well, thank you, Rodney, and thanks again for your service on the FDIC board and as part of the interagency process. We do require a sunshine motion to hold this open meeting on less than 7 days' notice to the public. May I have a motion?
So moved.
And a second? All in favor, please say aye.
Aye.
Aye. Any opposed? Thank you. The motion is adopted. There are several items on the summary agenda. Among the policy matters on the summary agenda are an interagency notice of proposed rulemaking to rescind the 2023 Community Reinvestment Act final rule and a proposal to improve the branch application process, which I will have a short statement on that I won't read in the interest of time, but will submit for the record. Are there any additional questions or comments on the summary agenda?
No.
May I have a motion to approve the summary agenda?
Move to approve the summary agenda.
And a second?
Second.
All in favor, please say aye.
Aye.
Aye. Any opposed? Thank you. The motion is adopted. We have 3 items on the discussion agenda. The first item is a notice regarding proposed amendments to the FDIC guidelines for appeals of material supervisory determinations. James Watts and Shika Kapoor will present the case. I'll ask them to come forward. And when you're ready, you may begin.
Good morning. My name is James Watts, and I'm an attorney in the legal division. I'm here with Shika Kapoor, also from the legal division. Today, staff is presenting a notice and request for comment proposing changes to the FDIC's supervisory appeals process. Federal statute requires each of the federal banking agencies to establish an independent intra-agency appellate process to review material supervisory determinations. To satisfy this requirement, the FDIC's board has established the Supervision Appeals Review Committee, or SARC, as the final level of review for material supervisory determinations. The SARC has been comprised of FDIC board members and other senior FDIC officials. The proposal would replace the SARC with a standalone office within the FDIC, known as the Office of Supervisory Appeals. The office would be independent of the divisions that make supervisory determinations. The proposal also includes certain other enhancements to reflect experience administering the supervisory appeals process, some of which I'll mention today. The office would report directly to the FDIC chairperson's office and have delegated authority from the board to consider and resolve appeals. Reviewing officials, as employees of the FDIC, would be part-time intermittent employees who've been cleared for conflicts of interest and are subject to the FDIC's requirements for confidentiality. Reviewing officials would have direct experience with the supervisory process, and the proposal recognizes that this could be achieved through both government and industry experience. Thus, in addition to former government officials with supervisory experience, the proposal provides that the FDIC would consider former bankers and other former industry professionals with relevant experience to serve as reviewing officials. Based on past experience with respect to staffing the office, staff would plan to initiate the hiring process in the near term so that the office may be fully operational as soon as final guidelines are in place. When an appeal is submitted to the office, a panel of 3 reviewing officials would be assigned to consider the matter. At least one member of any panel would be required to have bank supervisory experience. The office would review appeals for consistency with the policies of the FDIC, including regulations, guidance, policy statements, examination manuals, and other written publications, and the overall reasonableness of and the support offered for the positions advanced. The office would make an independent supervisory determination without deferring to the judgments of either party, underscoring the independence of its review. Recognizing the value of the Ombudsman's perspective, the proposal would allow the Ombudsman to submit views to the panel for consideration. In addition, the proposed guidelines would retain provisions regarding the Ombudsman's oversight of the appeals process and monitoring of the supervisory process for retaliation against an appealing institution. Until the office is fully operational, the current guidelines would continue to apply, and all appeals of division directors' decisions would be reviewed by the SARC. Transition from the SARC to the office would occur upon or following issuance of final guidelines. The notice would request comment on all aspects of the proposed guidelines with a 60-day comment period. We'd be happy to answer any questions you may have. Thank you.
Thanks, James. I have a statement, and then I'll turn to the other board members. The FDIC first established an appeals process to review material supervisory determinations in March of 1995 with the creation of the Supervision Appeals Review Committee, or SARC. The SARC typically consists of FDIC board members and deputies of FDIC board members, individuals who serve on the SARC concurrent with numerous other duties, and who, in many cases, have never participated in a bank exam. In 2020, the FDIC board approved a proposal to replace the SARC with a novel approach to reviewing supervisory appeals, an independent standalone office staffed with officials whose sole job would be reviewing and deciding on supervisory appeals. The new office became fully operational at the end of 2021, but following a leadership change at the FDIC board, was disbanded before hearing a single appeal. The rationale for instituting the new office 4 years ago remains the same today. First and foremost, the intent of the proposed office is to promote an independent, apolitical, and consistent appeals process. By recruiting externally, the FDIC anticipates attracting impartial candidates who are less likely to have established relationships with individuals involved in the supervisory process. Imposing time-limited terms decreases the likelihood that officials would serve in furtherance of longer-term career goals. Establishing the office as a standalone entity within the FDIC, whose sole function is to resolve appeals, would also ensure that reviewing officials have the capacity to review each case with the proper level of attention and diligence, and would be scalable should the volume of appeals increase. In comparison to the 2021 guidelines, the proposal would expand the pool of potential candidates eligible to serve as reviewing officials by broadening the types of experience the FDIC would accept. Still, at least one individual on any appeals panel would need to have direct supervisory experience from a supervisory agency. This would ensure that reviewing officials have the proper expertise to understand the range of issues that might be presented. In addition, a more robust appeals process with an independent body will further help ensure that examiners are applying policies consistently across the country. I thank the staff for their work and look forward to receiving comments. Director Hood?
Great. Thank you, Mr. Acting Chairman. I too will be supporting this morning's recommendation. I would like to support the proposed amendments to the guidelines for appeals of material supervisory determinations. Reinstating the Office of Supervisory Appeals promotes independence and transparency in the appeals process. The inclusion of potential reviewing officials, such as former bankers or other former industry officials, I think is a positive change from the previous version of this particular office. These individuals will bring valuable perspectives that may benefit the overall appeals process. So thank you all and thank the staff for putting this together. And again, I'll be enthusiastically supporting.
Director Vogt?
Really important initiative. Couldn't be happier with the setting up of the office, hearing the proposal. Look forward to supporting it.
May I have a motion to approve the resolution to adopt the notice regarding proposed amendments to the FDIC guidelines for appeals of material supervisory determinations?
So moved.
And a second?
Second.
I will now call the roll for the vote. I vote aye.
Aye.
Director Hood?
Aye.
Director Vogt?
Aye.
Thank you. The motion is adopted. Thank you to the staff. The second item is a notice of proposed rulemaking regarding adjusting and indexing Part 363 of the FDIC's regulations and certain other FDIC regulatory thresholds. Drew Karianis, Christopher Blickley, and Chika Kapoor will present the case. I'll ask them to come forward. I guess maybe we only got two. We lost one along the way.
Okay.
And when you're ready, you may begin.
Good morning, Acting Chairman Hill and members of the board. For your consideration today, staff is presenting a proposal that would amend certain thresholds in the FDIC's regulations that are used to determine the scope of applicability for various requirements, including those set forth in Part 363 related to annual independent audits and reporting. Specifically, the proposal would update thresholds to reflect historical inflation and other policy considerations, as well as provide for implementation of an indexing methodology that would automatically adjust thresholds under a predetermined schedule to reflect inflation over time. In general, the use of thresholds allows the FDIC to differentiate and tailor the application of regulatory requirements based on an institution's size, risk profile, and level of complexity. Under the FDIC's regulations, most thresholds are static, with no mechanism for periodic adjustments to reflect inflation. However, experience has demonstrated that the use of static thresholds can lead to unintended policy consequences. For example, when thresholds are static, an institution can become subject to additional or more stringent regulatory requirements due solely to inflation, rather than actual changes in the institution's size, risk profile, or level of complexity. The adjustments provided for in this proposal would address this outcome by helping to preserve, in real terms, certain threshold levels in the FDIC's regulations. The proposal would initially update certain thresholds to reflect the cumulative change in inflation from the date of initial implementation or the most recent quantitative adjustment. Additionally, the proposal includes an indexing methodology for subsequent periodic threshold adjustments that would be implemented automatically every 2 consecutive calendar years based on the cumulative percent change in inflation since the effective date of any final rulemaking, or during any intervening calendar year when the cumulative change in inflation since the last adjustment increases by more than 8%. These adjustments would be effective as of April 1st of the year the threshold is adjusted. As part of the proposal, FDIC staff considered alternative approaches for updating current thresholds and for adjusting thresholds in future periods. These included alternative measures of inflation and other methods that could be used as a basis for updates or adjustments, such as measures of economic or banking industry activity. Staff also considered alternatives for the frequency and manner in which threshold adjustments should be made. The proposal would seek comment on all aspects of the initial threshold updates and the proposed indexing methodology, with a comment period that would close 60 days after publication in the Federal Register. The proposal would be the first of a multi-phase effort to reevaluate thresholds within the FDIC's regulations. Staff expects to present for the board's approval one or more subsequent proposals to adjust additional thresholds and, as appropriate, would seek to coordinate with other federal agencies. Thank you. We are happy to respond to any questions you may have.
Thank you. I have a statement, and then I'll turn to my fellow board members. The FDIC's regulations are replete with static, asset-based, and other numerical thresholds, which play a critical role in the FDIC's efforts to tailor our regulatory framework. However, as the value of the US dollar depreciates over time, static thresholds steadily decrease in real terms, and the scope of applicability of related regulatory requirements expands. We have spent the past few months inventorying and bucketing our numerical thresholds and considering options to update and index them to offset the effect of inflation. Today's proposal includes an initial tranche of thresholds that the FDIC is proposing to raise and index, including a couple dozen thresholds found in Part 363 of the FDIC's regulations, which imposes audit, internal control, audit committee composition, and related reporting requirements. These thresholds have not been raised in decades and present meaningful challenges for small institutions that have become scoped into the rule. For example, small institutions in rural areas may experience difficulties attracting and retaining individuals with the requisite experience to satisfy the rule's audit committee composition requirements. Today's proposal is designed to keep thresholds constant in real terms by indexing thresholds for inflation. It would mean the size of an institution scoped into an asset-based threshold would not change based on the changing value of the dollar. Beyond the proposal, the FDIC continues to evaluate a range of other thresholds. For example, we are actively considering changes to the continuous examination program, including the associated threshold, and we are closely evaluating the appropriate threshold for the large bank pricing scorecard for deposit insurance pricing, currently set at $10 billion. We also plan to engage with other agencies on interagency thresholds as appropriate. I thank the staff for their work on this proposal and look forward to receiving comments. Director Hood.
Great. Thank you, Mr. Acting Chairman. First of all, thank you all for your presentation this morning. I have long advocated that regulation needs to be effective and not excessive, and this recommendation is a step in that direction. I really support the updating and indexing of these thresholds. Doing so should provide a more durable and fairer regulatory framework by helping to maintain in real dollar terms the thresholds at levels where they were initially set. This will help to avoid the less than optimal outcome where the scope of applicability for regulatory requirement changes due solely to inflation rather than actual changes in an institution's size, risk profile, and level of complexity. So I'm excited to support this. I do wish everyone that this is something that I'm about to ask that's beyond our control at the FDIC, but I wish we could look at a similar exercise for BSA and AML thresholds as well. Again, beyond the scope, but I've gone on record on numerous occasions of saying that we should look at other opportunities to index some of our terms for inflation. So thank you.
Director Vogt.
I'm support of the proposal.
May I have a motion to approve the resolution?
I move to approve the resolution.
And a second?
Second.
I will now call the roll for the vote. I vote aye. Director Hood.
Aye.
Director Vogt.
Aye.
Thank you. The motion is adopted. The final item on the open agenda is a request for information regarding industrial banks and industrial loan companies and their parent companies. Sandy Macias and Catherine Topping will present the case. I'll ask them to come forward. And when you're ready, you may begin.
Good morning. I'm Catherine Topping, counsel in the legal division, and this is Sandy Macias, my colleague from the Division of Risk Management Supervision. We're here to present a request for information on industrial banks and industrial loan companies and their parent companies. The RFI would seek public comment on how the FDIC reviews certain applications and notices submitted by industrial banks and industrial loan companies, together referred to as industrial banks, in the context of its evaluation of the statutory factors governing such filings. As noted in the preamble of the RFI, all existing FDIC-insured industrial banks are state non-member banks, and as a result, the FDIC is the appropriate federal banking agency and supervises these institutions. Each industrial bank is also supervised and regulated by its state chartering authority. The Competitive Equality Banking Act, or CEBA, of 1987 excluded industrial banks from the definition of bank in the Bank Holding Company Act. And as a result, a company can control an industrial bank without being a bank holding company and subject to the Bank Holding Company Act's restrictions and supervision by the Federal Reserve Board. Currently, there are 24 operating industrial banks owned by both financial and commercial firms. Under CEBA, 5 states that were permitted to grandfather existing industrial banks continue to charter new industrial banks. Those states are Utah, Nevada, California, Hawaii, and Minnesota. Industrial banks are subject to the same restrictions and requirements, regulatory oversight, safety and soundness examinations as any other state non-member bank under federal law. Additionally, Part 354 of the FDIC's rules and regulations governs the parent companies of industrial banks. FDIC adopted Part 354 in December of 2020 to formalize its supervisory framework for industrial banks and to mitigate risk to the deposit insurance fund that may be present in the absence of federal consolidated supervision of an industrial bank and its parent company. Part 354 requires certain conditions and written commitments for each deposit insurance application approval, non-objection to a change in control notice, and merger application approval that would result in an industrial bank becoming a subsidiary of a company that is not subject to federal consolidated supervision, referred to as a covered company. Part 354 also requires each covered company and the industrial bank to enter into capital and liquidity maintenance agreements and other written agreements with the FDIC. Additionally, Part 354 requires FDIC's prior written approval for certain actions by the industrial bank, such as a material change to its business plan. As for the request for information, there's been a renewed interest in the industrial bank charter. In light of this, through this RFI and the comments we received, the FDIC is seeking to review the nature and structure of companies that have applied or may in the future apply for an industrial bank charter and federal deposit insurance, and the issues those applications and certain other filings involving industrial banks may present. This review will inform the FDIC's efforts to determine how the agency may adjust its policies regarding how it would evaluate the statutory factors in the context of the unique aspects of industrial bank applicants' business plans and the issues presented by the range of companies that may seek to establish an industrial bank. Towards that end, the RFI discusses the statutory framework, provides background on the currently operating industrial banks, and asks a broad range of questions covering topics such as information relevant to the evaluation of the applicable statutory factors and the characteristics and complexity of industrial bank parent companies. If approved, the RFI will be published in the Federal Register with a 60-day comment period. We're happy to answer any questions you may have.
I have a short statement, and then I'll turn to my fellow board members. The FDIC's approach to industrial loan companies, or ILCs, continues to generate strong views from a wide range of perspectives. High-profile developments in this area over the past several decades are well known, and I have previously discussed some of them in greater detail. I have also expressed my view that the FDIC should solicit feedback from the public on a comprehensive set of questions related to ILCs to inform its policy development. Today, the FDIC board is considering a request for information that would present stakeholders with an opportunity to provide feedback to inform the FDIC's approach to ILCs. This RFI is particularly focused on information relevant to the evaluation of applicable statutory factors when reviewing ILC applications. Although many of the arguments related to ILCs are familiar, sustained interest in the charter by a diverse set of institutions suggests that a wide-ranging RFI would be a helpful step. As I have said previously, I believe our ultimate objective should be a policy statement or similar issuance that provides clarity on how the FDIC interprets the applicable statutory factors in the context of ILC filings. At the same time, we will continue work on pending ILC applications that have been filed with the agency. I would like to thank the staff for their work on this RFI and look forward to reviewing the comments. Director Hood?
Thank you, Mr. Acting Chairman. I too will be supporting the RFI, and I want to thank staff for their hard work. I have no questions.
Director Vogt?
I support the RFI.
May I have a motion to approve the resolution and request for information?
So moved.
And a second?
Second.
I will now call the roll for the vote. I vote aye. Director Hood?
Aye.
Director Vogt?
Aye.
Thank you. The motion is adopted. This concludes the open meeting agenda business for today. Unless there's any new business, the open meeting is now adjourned. Thank you, everyone. We will now convene the closed meeting of the board.